How can I help you? What are you looking for?
So I like your concept of, the buy and hold. Um, I feel like I know a lot of families. I'm coming from, Mexican side, so
Mm-hmm.
I have a lot of families that I feel like I can help, with the with the seller finance,
Mm-hmm.
as in help them get into homes, because I know a lot of them, they want to be homeowners, but they can't qualify for whatever reason. They have good jobs,
Mm-hmm.
but they don't have credit. They don't have social. So
Mm-hmm.
I don't know if you asked for a social or not. So that was kind of what I was asking for.
Nope. As long as they have the right to be in the United States, I can get them approved.
Okay.
And I know there's different documentation for that. But yeah, so I'm heavy in Tucson, and most of my clients down there are all Hispanic.
Okay.
And I don't speak Spanish. I've got people in my office that do. And I have a great maintenance guy down there just because I've worked with him since 2017, which is bilingual. So, but I have a lot of clients down there that are just what you're talking about.
Okay.
They're very loyal. They got great jobs. They don't have a social. They don't need it as long as they are legally can work in the United States. I can get them approved
Okay.
because I'm the bank. Okay.
Yeah.
So if you're talking about seller financing and that side of it, you got to look at Dodd-Frank, which is the SAFE Act. And as long as the underwriter will approve them with their documentation, you're good to go. And as long as you're okay with doing it from your end and being the bank for them, you're fine. And I have had people that don't have socials that I've approved, and they have seller financing with me. I do not have a problem with it.
Okay.
So yeah, so it's just a matter of how you acquire the building, and then how do you work the numbers to make sure it's going to cash flow for you, so that you're not getting into a situation. So typically what we do is once we acquire that property, we usually do a 5-year lease / option. I do that because a lot of people, maybe they're coming up from Mexico or whatever, Dodd-Frank wants to see 2 years of employment. Okay. They don't have to work for somebody. They can be self-employed, because I get a lot of handymen that come up, or, they might work in the roofing industry or the trades of some kind.
Yeah.
That's perfectly fine as long as they have 2 years of history of that work and can prove their income. So if they're getting cash under the table, I don't care as long as it goes into a bank account. I have to have bank statements, and they're going to want 2 years of bank statements. Okay, so that works. They have to have, if they have credit, at that point, they can't have any derogatories on their credit. So no charge off, no collections, no derogatory credit, because they are going to look at that. They don't have to have a great credit score, but they do have to have some type of credit. Okay.
Okay.
And when I say some type of credit, it could be a cell phone, it could be utility bills, that kind of stuff. And then they just have to have the income to support it. If they have the income to support it, usually you can get them approved through Dodd-Frank. Okay. And do you know what Dodd-Frank is in the SAFE Act? Have you heard of that?
No, I haven't.
Okay. So that is a law that came down back in 2008 when the market fell out. What was happening is banks were over leveraging people, and giving them like 125% of the value of the home, and the house wouldn't even support it. And so what happened is when all that happened and the real estate market crashed in 08, a couple senators, Senator Dodd and Senator Frank, came out with this new law that people have to get pre-approved and get qualified from people like me that do seller financing to make sure I'm not doing predatory lending to the point that I'm taking advantage of them. Okay. So we have to hire a third party, somebody away from my company, a third party underwriter, to go through all these numbers, and they get a new credit application. They get all their paychecks or bank statements, whichever that is, and they do the qualification. And they'll either come back denied, contingent on something, or approved. Okay. So, but it's not as hard as getting approved through a bank. Banks are very hard to get approved through. Okay. So the the law isn't real stringent. As long as they have those 3 or 4 things I just talked about, they can get approved.
Okay.
Okay. But if you're doing this, are you doing this full time now or?
Yeah, I want to switch to it full time. It's just sometimes I have a little bit of hurdles as far as in like I'm not all there with the contracts. So I pretty much have like a bit simple like 2-page contract. So far I've only done one deal,
Okay.
like a wholesale deal.
Okay.
I was trying to keep it because he I mean he had a 16 mortgage of 1100.
Mm.
It was near GCU.
Yeah.
Oh, rents are pretty good there. It's just I didn't have the connection or how to do you do wraps too or no?
I do it all. So, like I said in the podcast, I started in 1993. My mentor at that time, I was very, very lucky because you didn't have the internet and stuff like you do now. So back in 93, he was a family friend of my sister's, and he was one of the head brokers here in town. And so I hooked up with him, and he's the one who mentored me. I don't do sub-2s. There's a difference between a sub-2 and a wrap. I
Okay.
do wraps. Okay. And the difference is the sub-2 that they teach today is you're taking advantage of a seller. You're just taking over their note, making that payment. But what happens if you quit making that payment? That seller has no recourse to get that house back. Okay. That's the bad thing about the sub-2s they teach today. What I do is a wrap. What that means is it's still, call it a sub-2 wrap because it's still taking over the existing mortgage, just like a sub-2 does. But I also give the seller a promissory note and I give them a deed of trust. So if I quit making payments, they can go foreclose on me. Okay. Just like the bank can foreclose on somebody that quits making payments. So it secures that seller. So I do that. That's how I do my sub-2 stuff. Okay. It's a lot more work, but it secures the seller. And then we do a ton of seller finance. We do what we call hybrids, which can be a combination between your wraps and seller finance. We'll even do a wrap and bring in private money if we need to pay off the seller some additional money, that kind of stuff, which I call a hybrid also, but I'm using private money instead of the seller's money. So we do all that. So probably 90% of everything I buy is with creative financing. Okay. I like I say, my very first deal was a creative deal back in 93. Okay. And that's how at one point in time I had 120 some doors just right here in Mesa. And most of them were bought with creative financing. Well, now I have a portfolio in 15 different states, and most of them were bought with creative financing. The other thing we do is we will pay cash for stuff. But when I pay cash, I'm bringing private money in, paying my private money lenders 8-10%. And then I let it season for a period of time. And hopefully we bought it deep enough that I can do what they call a DSCR loan, which is a new loan, but the property stands on its own. So they don't look at my income, my tax returns, none of that stuff to do these loans. Like right now, I'm doing 13 of them. Okay. And then I get my private money back out and I take that private money and I go buy another property. So that's how I do my cash deals. I don't use any of my own cash to do it. Okay.
So I mean, even if I were to get a deal here, I mean, you'd look into it, right? I mean, if it makes sense.
Yeah.
Like, let's say a lady has a $200,000 mortgage. Her ARV is maybe like 370. She wants 300. I mean, is that something that would make sense?
Possibly. We'd have to run the numbers. So if you're going to take it over as a wrap, I need to know what her mortgage payment is, the PITI.
What if she just wants cash? She just wants you to buy her out.
Then at that point, I'd have to see if she how much does she want? You said
300?
She wants 300. So it depends on where you're going to get the 300 at. Okay. What is that money going to cost you? I have my guys calculate everything at 12%.
Okay.
So basically at 300,000, if I got to go get private money for 300,000, it's going to cost me $3,000 a month. What's the rents in the area? 2,700, 2,800, you know, it's not going to work. If rents in the area are 35 to 3,700, you probably got a deal. Okay. Now, can you get cheaper money? If you can get cheaper money, then great. You know, we just figured at 12% because at 12% you're safe.
Okay.
DSCR loans, for example, 300 and right now there's 7.125 enter. Yep. So if you do a DSCR loan, which is at about 7.125 right now with some of them that I'm doing, that payment is $2,021. So now you have to add taxes and insurance on top of that. So now you're maybe 2,300, 2,400. Okay. And if you can get 27, 26, 2,800, I usually want to see a $400 positive cash flow. Okay. So if you're at 23, if I can get 2,700 out of it, which I might be able to, now I've got a deal. Okay. Now what I might do is I need to make sure there's enough equity in it. So my guys are always told to figure out DSCR loans. I need to buy that at 75% of loan to value or 75% of appraisal is what I look at. Okay. So what's ARV on it, you said?
370.
370. So really you need to buy it at about 277. Okay. And you said ARV. Now, will it appraise for 370? That's a whole nother thing.
Okay.
And sometimes you can get a DSCR loan at 80%, and that means you have to buy it at 296. Okay, to do the DSCR. I'm real. ARV is one thing of what us as investors look at. Appraisals are a whole nother story.
Yeah.
Oh, they can blow you out of the water, and if you can't get it appraised, you're screwed. I'm doing 2 deals up in New Mexico, and one appraised, and the same appraiser. One appraised exactly where we thought it would. The other one came in $40,000 less than what we thought it would, which makes no sense because the house that came in less is a bigger house, nicer house than the one he appraised for the right number. And we went and argued with him. And he said, nope, not going to do it. And they're only 3 miles apart. Makes no sense. So he basically fucked me on that deal, and I can't do a DSCR loan on it. So now because of that, I have to let it sit in season for a little bit longer, and which I'll do. I'll sit for probably 6 months, and I'll try and do another appraisal on it and see if I can DSCR loan it then, and hopefully get a different appraisal.
Okay.
So there's ways around it. Is this a deal you have right now?
No, which is kind of an example. A deal that I have is I have a rental home. I actually owe like 200. I'd like it appraised around 400.
Okay.
So I'd like to do that lease option thing, but I would like to get some money out of it first.
So you go ahead and do the lease option, which is fine. That has nothing to do with the new loan that you're going to put on it. And you can just do a DSCR loan. What's it rent for right now? Or do you have it rented?
2,300.
2,300?
Yeah.
Yeah. So, and you think it appraised for 400?
Yeah. I owe 200. Yeah, because I remodeled the whole thing pretty much.
Okay. So if it appraised at 400, that means at a 75% loan to value, you're at 300,000. You know what? Here, let me go one step further here. Hold on.
And would it be better to get a DCR loan, or would it be better just to do it with the bank?
DSCR loans are you have to qualify at a bank. You don't have to qualify for DSCR. So if you can qualify, that's fine. But now you have a recourse loan. That means that if you go belly up or whatever, the bank can come after you to get repaid. DSCR loans don't use any of my credit and don't show up on my credit bureau.
So I'd be switching from a conventional to the DCR, right?
Mm-hmm.
Because now it's
two totally different things.
Okay.
Yeah, conventional is going to be insured through the government typically. DSCR loans are third-party type lenders.
I mean, right now, I guess it wouldn't make much of a difference, right? Because I mean, the interest rate is like at 6.5 right now.
Not on DSCR loans or not.
No, on conventional.
Not on investment property, no. Usually they're about 1 point higher for investment properties than they are residential. So if you look up and the rates are 6.5, you're probably gonna be paying 7.5 on an investment property, even if you go conventional.
Which is not too bad. It's
No,
not
like the ones I'm working right now, they're all low sevens, like 1.125. Let's see, and pull what I'm going. In fact, my broker just texted me while I was sitting here. Like I got one that's at 7.625, one's at 6.875, one's at 1.125. So they're all right there, the low sevens.
okay.
So let me just run this other deal for you, because a DSCR loan is all figured off of what it appraises for. So I'm going to punch in $400,000. Loan amount, you've got 200. You've got rental rate of 2,300.
And I could push it up to a little bit more because my friend just rented a house like around the corner for freaking 2,600, not remodeled or anything.
Okay.
But that's just what I have it at 23, sorry.
Yeah, so that actually works out perfect. So with this particular scenario, with 2,300 works. So what happens on DSCR loans? They look at your rent that's coming in compared to your mortgage, taxes, and insurance. And if it's equal, if they're both at 2,300, the DSCR rate is 1. You really want it above 1. So in this scenario, at exactly 75% on a $400 value, the loan will be $300, but your TI payment and the insurance and stuff might be a little bit off. Do you know what your insurance is on it and your taxes per month?
Yearly it's 1,200, so 100 insurance.
Okay.
And then taxes, I think was about the same. So yeah, like 200.
Okay, let's just use that. So with that, yeah, you're just a little bit off. So hey there.
She woke up. Like, oh my God.
That your DSCR get you. You're not quite there. You're at 0.9899. So if you have a good broker, they will do like a 70. You'd have to raise your rents just a little bit. So let's just say you took that rent up to 2,400, and I'll tell you something here in a minute. But at 2,400, now you got a deal at a 75% loan to value. Now you got a deal, and you with that particular one, cash out wise, after closing expenses and title work and so forth, you put about $76,000 in your pocket doing a DSCR cash out. So it doesn't cost you a dime, and you put $76,000 in your pocket. Okay, so you got a good deal there.
Okay.
Yeah, you've got something there that work. Now I'll tell you something different. So rentals, when we go do our analyzation of rents, we look at Zillow rents, we look at Rent-A-Meter rents, and we always value everything off of the lowest number. So here, let me show you something here. Hang on. Let me
well, it kind of be on that deal, it kind of be costing me around like 20,000, right? Because I'd be asking for 300, I'd be getting 76.
Yeah, so you have expenses in there. So you're going to have some points in there and some closing costs, so forth. You're paying off your underlying note, the 200,000. Okay, so by the time you pay all your expenses and title work and all that kind of stuff, you'd get about 76,000 is what my calculator is telling me.